Welcome to The Explainer. Today, we are pulling back the curtain on a fascinating and frankly kind of weird puzzle in the world of finance, the strange case of silver. You see, for years, investors have been scratching their heads, wondering why, despite soaring demand, its price just seems, well, stuck. We're going to get into why that might be. So let's just dive right into the heart of the mystery. Silver is a precious metal, right? It has incredible industrial demand. Think solar panels, EVs, electronics. And yet, its price has been a dramatic underperformer compared to its big brother gold. On the surface, it just doesn't make any sense. So what is really going on here? And this chart, wow, this really puts the problem into sharp focus. For most of history, it took about, say, 16 ounces of silver to buy one single ounce of gold. That was the norm. But look at where we are now. It's blown out to over 88 to 1. This isn't just a little market fluctuation. This is a massive, glaring distortion that's telling us something is fundamentally off in this market. Okay, so to really get this, to solve this puzzle, you first have to understand a crucial fact. There isn't just one silver market. No, there are two completely different worlds operating at the exact same time. And this, right here, is where the story gets really interesting, because they are not playing by the same rules at all. So on one side, you've got physical silver. We're talking actual coins and bars, metal you can hold in your hand. There's only so much of it. It's finite. But then you have paper silver. These are things like futures contracts, ETFs, unallocated accounts, and they aren't the metal itself. They're just a promise for the metal. And this is where the game is played, because you can create a seemingly infinite supply of these paper promises, completely overwhelming the real physical supply. And if you want to see just how crazy the scale of this paper market is, look at this number. Some reports show that for every single ounce of physical silver that's actually available for delivery, there can be up to 378 ounces worth of paper claims floating around out there. Just let that sink in for a second. The huge majority of silver being traded doesn't even exist in a vault waiting for its owner. So how can this massive paper market actually dictate the price of the real stuff? To get that, we need to take a look at the playbook of the game's biggest players, the bullion banks. They know exactly how this works. Okay, one of their key tactics is something called spoofing. Imagine this. A trader puts up a gigantic wall of sell orders. It's huge. It creates this illusion of massive selling pressure. So what do other traders do? They see it, they panic, and they start selling, driving the price down. But then, just seconds before those big fake orders are about to be filled, the spoofer cancels them all and then buys up silver at the new lower price he just created. It's a high-speed head fake, and yeah, it's totally illegal. And this kind of activity leads to a pattern that investors have nicknamed the price slam, or the tamp down. It's this suspiciously consistent thing that happens, where huge volumes of paper silver contracts get dumped on the market, almost like clockwork, during the thinly traded morning hours in New York. It pushes the price down, often right when it looks like it's about to break out to a higher level. Now, if you're thinking this all sounds a little out there, or maybe like some kind of conspiracy theory, you have to hear this. That term, tamp down, it doesn't come from some anonymous internet forum. It came directly from a top regulator. During a big price surge in 2021, he admitted, on the record, that they actively pushed the price down to prevent a worse situation. He basically confirmed the game. And the proof? Oh, it doesn't stop there. Not by a long shot. For 8 years, JP Morgan's top precious metals traders were caught systematically manipulating the market with literally thousands of these illegal spoof trades. It led to a record-shattering fine of almost $1 billion. And this is the crucial part, criminal convictions. People actually went to jail for this. This isn't theory. It happened. It's a documented fact. You see, this whole paper system works just fine as long as not too many people ask for the real metal all at once. It's a classic fractional reserve game, and it's built entirely on trust. But what happens when that trust starts to wobble? What happens when everyone calls in the promises and the very plumbing of the market starts to break? Well, we got a glimpse of that exact scenario playing out in London, which is the clearing hub for the entire world's silver market. The inventories of physical metal got so dangerously tight that there was a very real risk of the whole system just seizing up. They simply didn't have enough real silver bars to back all the paper claims that were being made. And to stop the system from completely collapsing and defaulting on its promises, over 53 million ounces of physical silver had to be rushed in from all over the world in just 1 month. Think about that. It was this massive emergency airlift of metal, and it showed everyone just how fragile the whole system really is. And this points to the ultimate risk in this game, something called an allocation run. You should think of it exactly like a classic run on a bank, when confidence disappears and everyone rushes for the exit at once, demanding their physical metal. The first few people in line might get it, but the system jams up almost instantly, leaving everybody else with nothing but broken promises, long delays, or maybe a cash payout at a price they never wanted. So, after seeing how this whole game is played, what's the big takeaway for anyone interested in silver? Well, it all really boils down to one fundamental question. Do you own a paper promise or do you own the actual metal? This chart here makes that distinction crystal clear. If you own physical silver, or if you have what's called an allocated account, it means that there are specific, numbered bars in a vault somewhere with your name on them. They're yours. But with most of the popular ETFs, your account is unallocated. You just own a share in a giant pool of metal. You are totally exposed to the paper game we've just been talking about, and if a crisis hits, you probably can't just call up and ask for your bars. So let's just boil it all down. The crucial points are these. There is a massive disconnect between paper promises and physical silver. We know for a fact that this disconnect has been exploited by major financial players. This creates real systemic risks. And most importantly for you as an investor, it is absolutely vital to know exactly what kind of silver you actually own. And all of this leaves us with one final, very provocative thought. The entire paper-silver system, the one that sets the price we see on our screens every single day, it all functions on trust. It's a house of cards built on promises. But in a world that feels increasingly fragile, you have to ask, what happens when that trust finally evaporates and everyone, all at once, asks to see the metal?